Hello and welcome to Economic Lifelines Nigeria, your in-depth look at how Nigeria's authorities are providing vital support to key sectors of Africa's largest economy. I'm Keisha Gitari. In today's program, we delve into the often turbulent world of Nigeria's downstream oil and gas sector to uncover the potential economic impact of this segment of Nigeria's oil and gas industry. Nigeria is home to large volumes of oil, producing approximately 2.5 million barrels per day, making the country the sixth largest oil exporter in the Organization of Petroleum Exporting Countries, OPEC. Oil was first discovered in Nigeria in 1956. And since then, the nation has seen billions of dollars flooding the Nigerian government and attracting significant investment from international oil producers. However, these gains have not translated into inclusive growth for the economy, as over 60% of Nigerians continue to live below the poverty line, while general infrastructure remains woefully inadequate.
50 years ago, oil was discovered in Nigeria. Now, how were we getting our refined products? There was a refinery, the only refinery in Nigeria then. It was in Port Harcourt. It was operated by Shell and BP. And it was sufficient. How was it possible? Even though demand was low, what marketers did then was they bought their crude and then took it to the refinery, refined, and then sold the product at a price that gave them some comfortable margins. So there was deregulation. But by the time the Civil War ended, there were some, first there was what they call costs of living allowance given, and it enabled the middle class to have some more money, and they bought more cars, and fuel consumption started rising. So what was sufficient in the 60s was no longer sufficient in the 70s. So government started building their own inland depots and pipelines, and still we were comfortable. But what happened was government now decided to make prices uniform. It wasn't uniform before 1973. And when it became uniform prices, then the problem started.
Nigeria's government has been widely criticized for the underdevelopment of the downstream oil sector, which remains largely untapped. Billions of dollars in much-needed foreign exchange, 8.8 billion last year alone, is spent every year on importing petrol and other refined oil products. Government-owned oil refineries have been poorly maintained and lack the capacity to meet the demand for a variety of refined petroleum products. The regulation of the petrol sector discourages the private sector from investing in much-needed oil refineries. As a result, the biggest oil producer in sub-Saharan Africa is a net importer of refined products. The poor performance of oil refineries has sparked many calls for the sale of these assets to the private sector. A similar fate met an array of underperforming government-owned power companies just last year.
The government set up the refineries and did not maintain the refineries. If that's what you call mismanagement, well, fine. But what I see there is that government ownership of the plant is actually a problem. For me, my position has always been that they should change the ownership or dilute government control such that the private sector will have more say in the refining process. If that one happens, there won't be any delay in turnaround maintenance. No private person will buy a refinery and will refuse to maintain it, knowing very well that lack of maintenance means shutdown of plants, which would then mean that the investor is going to lose his money.
The industry is actually unstable at the moment, especially for the product we call PMS, which is petrol. And the reason why that is so is because of the subsidy, really. Those importers who deal in PMS actually have to depend on allocations, which is given by the federal government on quarterly basis, and whatever is given is what is imported. But of course, the major challenge is the fact that we've seen situations where those allocations are not fully delivered because of funding. And that is as a result of the fact that previous deliveries were not being paid for by the federal government. So you have a situation whereby most of these, all of them actually go to the banks to borrow money, and at the end of the day, they are not able to pay to have the same funds available for the next round of imports. So you have a situation whereby you have the federal government in some cases not releasing allocations on time. You have the problem of outstanding loan obligations, which reduces the ability to be able to deliver on the new allocations. So you have a market that is not deregulated. So it is a case of whatever government does or whenever government pays. So that is the major instability we're experiencing in that space.
The downstream oil sector has, however, provided unique investment opportunities that some Nigerians have been savvy enough to harness. Aliko Dangote, Africa's richest man, recently signed a $9 billion deal with local banks to build a domestic oil refinery.
We have quite a lot of opportunities in Africa. Africa is not, it has actually come of age. And I think, the opportunities that we have here in Africa is, I think, second to none, really. So there are possibilities here. The trajectory is on, and we'll keep growing. We are going to have, a refinery with petrochemical complex, which will produce oil for not only Nigeria, actually for the West African region and some of the Central African area, where I think we'll be able to have the capacity to deliver petroleum products, and then polypropylene, making tires, and we have also the fertilizer. Fertilizer will be about 2.8 million tons.
Oil and gas currently constitute around 90% of Nigeria's foreign exchange earnings, but these gains are being eroded by the billions of dollars spent on importing petroleum products and government subsidies on the price of petrol.
The major challenge in that sector is the fact that there is no domestic production that is able to take care of the demand. For as long as we depend on imports, the vagaries of exchange rate and all that is going to affect whatever you are doing. So even when you have a budget that for a given period of time, it may not be enough by the time the foreign exchange rate issue comes in, because for as long as you don't have a stable exchange rate regime, chances are that the budget will go up. Now, in addition to that, because domestic production is very low, you still have a situation whereby you have some kind of round tripping, because it's more of rent seeking. For example, recall 2011, 2012, when we had the issue of a whole lot of backlog of payments, only for us to discover that most of them, or majority of those claims, were not genuine. So you have that. Basically, the market is not stable because nobody really knows what government plan is. We've been talking of deregulation, and we've seen companies planning towards that, and at the end of the day, it did not occur. So in the course of doing that, you found out that some companies actually lost money.
In 2008, the challenges facing the sector were heightened by the global economic and financial crisis. The sharp fall in crude oil prices that followed hit many petroleum product importers in Nigeria. Caught on the wrong side of a sharp price drop, importers came under significant pressure to repay loans used to finance trades.
At the time, at the 105, 115, and down to $35. I mean, you're talking about 70% or 80% reduction. I mean, crash, I would say, in the price. And you have people that have cargoes outside because once you arrive, you more or less lock in the price. But there's very few of the local companies that actually know the international know-how to be able to hedge themselves.
Following the crisis, renewed calls for the removal of fuel subsidy was lodged, only to be met with stiff opposition from trade groups. The billion-dollar question: where had the Nigerian government spent the hefty revenues from crude oil and fuel subsidies? The exercise served to further highlight a key challenge with the downstream: maintaining uniform prices across the country. Despite the federal government pricing petrol at 97 naira per litre, that's about 59 US cents, most parts of the north, south-south and southeast buy gasoline at prices above 100 naira. That's just over 61 US cents per litre. The differential is thanks to the proverbial middlemen, responsible for distributing Nigeria's fuel on behalf of the NNPC.
In the long run, what you find is that subsidies typically, from an economic standpoint, tend to are meant to protect consumption, quite all right. But at the same time, they have a fallback on fiscal policy, because as consumption expands, the subsidy element also expands. And for Nigeria, like most African countries found, it's been quite a journey since 2009, when oil prices crashed to $32 per barrel. But between 2009 and 2012, oil prices rose by over 150%. And along with the rise in oil prices, the subsidy element also increased significantly. So, I mean, that came at a cost. And for Nigeria, you're looking at something in the region of about about close to $1 trillion annually on subsidies alone. So that's quite a huge sum for any government. Despite the fact that we just recently rebased, I think it's still not such a convenient fiscal element in our national spending for the government to accommodate. So it is a huge challenge. But like you said, I think it's, is it the key? Is it the only solution to our problem? I think in itself, it's not the only solution. Deregulation has to be balanced with adequate domestic refining capacity. So for instance, you deregulate and you don't have adequate domestic refining capacity. What that means is that you will be importing pretty much everything. And of course, marketers will have to source products from various countries. Or essentially what will happen is we'll export our crude and also import. And it doesn't leave us too far off from where we are. What will happen is just that people can sell at the price they want to sell, and it will be quite high.
The pure economics of it says you should deregulate. But you have to have other factors to consider. You have to consider the hardship it may or may not impose on sectors of the economy. You have to consider the political environment of the economy. So I leave those decisions to people who can see the whole picture. But I do recognize that it's a difficult decision, and it's not one that should be undertaken lightly or casually. But I don't see the whole picture. I only see the economics of it. And the economics of it is persuasive that you should deregulate.
Market behavior tends to work with the law of demand and supply. And when you have supply shortages, whatever you do, whatever measures you put in place, you will end up losing money. It doesn't matter who is paying. And that is exactly what is happening here. There are those who have advocated the issue of new refineries coming up. And really, that is the way I also look at it, because if the supply is good enough, I mean, the local demand is being met through local production. I think even where you pay subsidy, there is not going to be so much issues in terms of having to deal with so many players, having to deal with sharp practices. Because, of course, what is the local demand, the domestic demand today? That should be about 30,000 metric tons per day for PMS. So if you have as many as 5-10 refineries that can do 450,000 barrels per day. These are demands you can easily meet locally. Now, that will reduce the number of players you'll be paying subsidy to if you actually need to subsidize. So that will reduce the number of players, and you will actually be dealing with serious players. Now, when you have situations, because of course, each payment you make, you are going to audit. When you have situations where you have overpaid, it is easy to claw back because you are dealing with fewer people and you are dealing with serious players that are not going to go out of business tomorrow. I think that is just the way to go. So it's not about removing or not removing subsidy. When you deregulate, you can still deal with subsidy.
After the break, we hear from Mustafa Chike Obi, the MD of AMCON, and get his perspective on the downstream oil industry and the role the Asset Management Corporation of Nigeria is playing in the downstream industry. Welcome back to Economic Lifelines Nigeria. Before the break, we looked at the challenges facing Nigeria's downstream oil sector and how the federal government's deregulation plan is initiating a turnaround. Now let's take a look at the role AMCON is playing in supporting the sector's regeneration. The Asset Management Corporation of Nigeria played a significant role in helping to stabilize Nigeria's banking and other sectors in the wake of the global financial crisis by buying problematic loans from Nigeria's banks. Many bad loans were granted to players in the downstream oil sector. Apart from rescuing the banks, AMCON's intervention also helps to avert the collapse of a vital industry in Nigeria's economy.
The downstream oil sector, as you know, is very important to Nigerians. Making sure that the long lines of petrol that we knew before never happens again is a joint effort of NNPC and the downstream oil marketers and the distributors. Many of them had run into financial difficulties because of, again, the crash in oil prices, the fall in the stock market, and the general economic downturn 2009-2010. And they all had large loans that had become unserviceable. So AMCON's intervention in that was to purchase the loans from the banks and then try and find a way to keep these oil marketers in business because they play a very critical role in the Nigerian economy. So far, I believe that at least 50% of oil marketers have loans with AMCON. And our objective was to find ways to support them in such a manner they could continue with their businesses. We have found that actually the actual work of the economics of downstream oil marketing is quite profitable. The PPMC and PPPRA templates ensure that they make a reasonable profit. And for those who have actually stayed strictly to the business of downstream oil marketing, they have done well. And what we're trying to do is to get them back to focus on the business of distributing petroleum products according to the PPPRA template. And I think that those that are doing that will do well. Our role is to restructure the loans, work with them in such a manner that they remain profitable. And one of the difficulties they're having is getting bank lines from the banks. And so we're trying to find a system of either guaranteeing their purchases abroad so they can import the petroleum and giving them some lines of credit or working with the banks to do so.
AMCON's role has been quite key in the sector because speaking from the banking perspective, it's back in 2012, a lot of the banks were exposed to debts from the petroleum marketers. In fact, statistics we have was about 400 billion naira debts from the petroleum marketers, which AMCON took over, and that helped in bringing some liquidity back into the sector because a lot of them were owed money by the petroleum subsidy fund, bridging claims. So all that was quite key from AMCON perspective. Another aspect which a lot of people tend to overlook also too, which AMCON did, was that AMCON took over about $1 billion of bad debt from the aviation sector as well. Now the bulk of that debt was actually also for sourcing of aviation fuel parts and the likes, but also aviation fuel, and that also was from the petroleum market's perspective. So a lot of petroleum marketers were actually owed money for aviation fuel, and those monies were also owed to banks. So it also, so in a way, AMCON actually came in to save the sector for almost about 1.4 billion worth of debt. So I think that was quite essential.
You will recall that just before the crash, the price of crude went up to as high as $140 per barrel. And just the following day, you saw it plunging to about $60 something per barrel. So that really distorted and disturbed the market, leading to serious losses, huge losses in that space. Now, what you saw was that most of those assets that were taken over or taken off the books of banks by AMCON were actually directly related to assets or loans that were granted to the downstream sector of the oil industry. So you see a large portion of the loans taken over by AMCON, being related to the downstream sector, and I think they really took a large portion of that from virtually all the banks. So that is what I can say about the role of AMCON in the whole downstream sector crisis of 2009-2010.
Bankers and oil industry players estimate that AMCON's intervention saved the downstream oil sector and kept over 50% of petroleum importers in business.
The success is best measured by the fact that we have not seen, except sporadically, any big disruptions in distribution of petroleum products. So from that point of view, objectively, you can say we've been successful. I can say that had there not been AMCON's support and assistance, you'll have had a huge problem. At least you will have disrupted at least 50% of the supply. So it's clear that we've been successful from the point of view that there has been no big disruptions. The second question is, how successful are we at getting our money back? I would say at this point it's average, and we're going to be more persistent in making sure that we get paid going forward.
AMCON has done quite well in the sector to help create liquidity to continue financing imports, because liquidity is very key in that business. You need to have adequate supply of funds to import, to sell, and to bring back again, and sell and import more again. So it's a revolving cycle of lending that is required. But when there are bad debts, I mean, the banks became really cautious to giving. In fact, at the point, the banks almost hesitated in giving new loans to most of the petroleum marketers. But all that has been resolved with AMCON's intervention in the sector.
As AMCON continues to recoup its investment in oil marketing companies, the pressure remains on the federal government to move ahead with its plans to deregulate the sector. No significant reforms are expected ahead of the 2015 presidential elections. But given the impact of subsidies on government revenues, industry players say deregulation can create much-needed jobs and put Nigeria's downstream sector firmly on the road to recovery. That's where we leave it for Economic Lifelines Nigeria today. Remember, you can catch this and past editions of the show on our website, www.cnbcafrica.com. Goodbye.